The broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone. Welcome to this webinar with from investing.com. Thank you so much for being here. You'll be sharing 1 hour of your afternoon with me, and we'll be going through the title of the webinar. Is just give me to this full screen. Yep. Will be my setups for week 12, 2025. Obviously, which markets I'm trading and why, using my rules-based roadmap. I'll be focusing instead of, because I follow about 60 markets, so I'll be focusing on a couple of them. So it will be both educational and analytical. What I'm hoping to do is basically show you the markets I'll be trading and why. Again, let me check if I've got any questions. All right, so if you can have any questions, feel free to um, write them down. Okay, so without further ado, let's begin. Right, so first of all, let's start with the usual risk warning. There is a very high degree of risk involved in trading. Past results are not indicative of future returns. S.M.A.R.T Trade Systems Limited and all individual affiliated assume no responsibility for your trading and investment results. I never, ever make any kind of promises or guarantees regarding trading, with the exception of one, which is that you will have losses in trading. That's the only guarantee I can give you during this webinar. Now, this is how usually my presentations end. And in order to avoid that, I'm giving free bonuses for those that manage to stay awake. The first one will be a paper I wrote in 2022 that was awarded twice by the National Association of Active Investment Managers. The paper is called MACTV Volatility Normalized Momentum. It receives the Founders Award for Advanced Active Investment Management, and also by the CMT Association, the Charles Dow Award. So that paper has been awarded twice, as I mentioned, by two bodies, professional bodies, on an innovation on technical analysis, volatility, normalized momentum, or MACTV. So that will be your first award, so first bonus for staying awake. The second is I'll give you the MACTV indicators on TradingView, stock charts, MetaStock, MT4, and Auto as they're being currently programmed. And also, we will be doing some, oops, I forgot to correct the date, some momentum model webinars. Actually, not the 4th of March, it's a few days after that, around the end of the month. So all you have to do is email me, alex@alexspiroglu.com. And of course, the same thing if you've got any questions. I'm also planning a lot of webinars and workshops within the next 4 weeks. I'll be having probably 1 or 2 per week on various topics, anything from how to pass trading challenges, MACTV, risk management. So feel free to email me so I can get you on the email list. Okay, so axiom in investments and in life. The truth. There is no free lunch. There are no free lunches in life and in trading. The closest thing you can get to a free lunch is portfolio diversification. That's the closest thing you could ever get to a free lunch in trading and investments. So how does one achieve diversification, the only so-called free lunch in investments? Well, basically, there are 3 ways to diversify your holdings. The first one is time frame diversification. Well, basically, have strategies that correspond to different holding periods. The one I follow, the strategies I follow for my portfolio is core, and satellite. Well, basically, there is a core strategy, which is long-term investing, usually lasts several weeks, using ETFs. And then I have some satellite strategies, which is either very short-term trading, 1 to 5 days, or medium term trading, more like position trading, 5 to 20 days. So through time frame holding having different holding periods, I can achieve time frame diversification. So that's one way. The second way you can diversify is through factors. Basically, have different return drivers. So, for example, have one strategy which is based on momentum, one strategy which is basically on volatility, one strategy which is based on seasonality, and so on and so forth. So, have different return drivers, different factors um, that provide sense for that trade to happen, for a basis of that trade. They can be technical, fundamental, or a mix. And the third way one can diversify is through asset classes. Well, basically, commodities, fixed income, equity indices, and forex, FX. So for these four asset classes, you can trade and can provide you with a diversification across asset classes, so timeframes, factors, and asset classes. So the challenge is, of course, that there are a lot of things to try to balance, if you will, in order to achieve diversification. Anything from hundreds of technical indicators to hundreds of macro indicators and data from different time frames. So a lot of things that demand your attention and can be factored in. So how does one um, combine this successfully? The problem is that any well-intentioned attempt to combine technicals and fundamentals usually results in information overwhelm, because on one time frame, technicals may say this, and another the fundamentals may say something, another one. So information overwhelm is something that is usually the result of people going down that route. So the in order to avoid that overwhelm, um, they fall into a different mistake, which is oversimplification. So they say, okay, I'll have a purely technical approach and just trade on a couple of indicators. And usually these indicators, are kind of like sing the same song, if you will. They are all momentum indicators and so on and so forth. So oversimplification is the trap they fall as, in order to avoid information overwhelm. So what is the solution? Yeah, let's try to put technicals and fundamentals, because I wholeheartedly believe, although I am a technician, I wholeheartedly believe that fundamentals should be combined with technicals. So you can have what I call a multiple time frame, multiple factor mindset or technique, if you will, that combines all these factors and these uh, time frames. So let's try to put everything into context. So first of all, you've got a monthly time frame. Usually the most dominant factor is the business cycle. You can look at, for example, um, try to understand what the business cycles to go through economic indicators. So I think that's the most important thing, or what markets are saying through intermarket analysis. So the monthly chart is the most important for conducting business cycle. What is the economy is doing, and what are the fundamental factors affecting the economy, and so for the asset classes on a more of a long-term perspective. Then secondly, you've got the weekly chart. Then you've got other macro factors like commitment of traders report, sentiment. Of course, you can do intermarket analysis also on the weekly chart. And then I go into the daily chart, and this is where I use my technicals. So all the technicals I do on the daily chart, which is the time frame I'm operating on. I don't do intraday trading, and I usually try to ask, persuade, but basically not encourage people from doing intraday trading. I mean, most of the people I know, I'm from on the retail side, who do not we're not as successful as they would like, either do intraday trading or are very leveraged or do options trading. So So after I've gone to the daily chart and check my technicals, then I, obviously have to trade, form the strategy following the 4S framework, which we shall see later on where it is. So this is the multiple time frame, multiple factor. So if you want to see it in a sequential basis, and this is the Smart Trade Systems program, trade development program I have. The as it called as I call it, the roadmap to rules-based trading. Well, basically this is the theoretical part, because I've got a theoretical and a practical part to the training. The theoretical part, which we'll be seeing right now, is for free, and we also have the information. We also have an implementation through coaching and community, and that is also that's where we actually put our attention. We don't focus on theory. So what is this roadmap that combines technicals and macro? First of all, as I mentioned, on the monthly weekly chart, we've got the macros, which is the basically provide context the why markets move. They go from point A to point B for macro reasons. Then I look at markets themselves, that is the technicals, which answer the question when. And this is the key difference of looking at macros and technicals. One is the why and one is the when. And then I've look at this and put this into a model, the 4S framework, as I mentioned previously, which is the how. So how we make combine technicals and fundamentals into a trade, and actually take it from theory to practice. So let's look at these factors that I look for: macros, markets, technicals, and the model. Look at 4 factors for each. First of all, okay, so macros, technicals, strategy. The first one I look at is the intermarket cycle. The intermarket cycle basically is the business cycle, which is the economy is comprised of 2 phases, contraction and expansion. And I've broken it down into early, mid, and late for the contraction, early, mid, and late for the expansion. So 6 different stages, which I try to use various economic indicators and market data, but also use several other components, models, indicators, either my own or coming from external sources. So I'll give you one of these, although we won't be going into the intermarket cycle itself, because it will take some time to explain. So let's look at one of the indicators. I use the smooth US recession probability model. So at this stage, what I'm trying to do is basically get a big understanding whether the economy is bullish or bearish, because that will set up my macro trades, and also give me an understanding either if it's for short-term trades, whether I should buy pullbacks or not. And I think this is quite pertinent with the recent correction that the S&P 500 equity markets had. The recent 10% equity decline that the S&P had. So the intermarket cycle will provide you the background information for you to answer the fundamental question: should I buy this pullback or not? Because if your intermarket cycle, your business cycle, is still bullish, then you should be looking to buy dips. Okay, maybe it's not 10%, maybe it's 15%, but by and large, you should be looking to buy the dip. So are we in a recession? I mean, is this what the current market decline depict fears for a recession? Because there is a talk about tariffs and so on and so forth. So let's look at in a quantified way the smooth US recession probability model. So this is the monthly chart. Let's try to explain a bit of the squiggly lines. The blue line is the recession probability model. When it is above 5%, which is that horizontal dashed line, as you can see on the vertical axis, it's highlighted as the number 5, then that depicts a recession. And as long as it is above that, then that is an increased recession probability. Now, this model goes back to the 1960s, and the black line is the Dow Jones index. And as you can see, when the blue line, which is the smooth US recession probabilities model, goes above 5%, then you usually have a recession, which is as defined by the National Bureau of Economic Research. These are the green shaded areas. And of course, you can see that how much it correlates with declines in the equity markets. Um, sometimes the markets start falling before the 5% threshold crossing, but sometimes it does afterwards. So sorry, quite near the top. So during this is how it looked like: 969, the 1973, 78, 79, and 81 occurrences. Now this is the 1990s. Again, it goes to show you the 5% crossing from the smooth US recession probabilities model. Then in 2000, a quite timely warning we had from the model. And then 2007, the big crash. For those of us that managed to survive that, the subprime crisis. Again, the recession probabilities model was managed to warn us. Again, 2020, that was COVID, and currently it is below 5%. So this model, as far as just this model is concerned, it goes to show you that we do not have to fear a recession coming into the economy. So any kind of pullbacks, as far as the this model is concerned, should be safe to buy. But of course, we don't never rely on one model or one indicator. So I'll show you a few more. As I mentioned, my main one is this 6-stage business cycle. Um, but let's look at some other the rest of the indicators, which can have less time to explain. So percent of inverted yield curves, that's another useful indicator. It basically shows you the number of yield curves that are under inversion, because there are many combinations depending on the duration of its yield curve you will be looking at, the various combinations. So again, this is the when the number of yield curves crosses the 60%, then usually you have a recession coming. Of course, that's not a market timing tool. This is how it looked like during the 2000. This is how it looked like in 2007. There was a prolonged warning from this particular indicator, but of course you have to be a bit vigilant, not to use it as a market timing indicator. Again, you have, and now that's where we are currently, 2023. There has been a lot of yield curves inverted. So again, we are at this point. Obviously, this, as I mentioned, there can be a long lead between yield curve inversions and bear markets and recessions, but just do bear that in mind. So the intermarket cycle model, although we haven't seen it, but actually what it shows you right now, we're in the middle part to late of the expansion. So we do have, I think, some ways to go for the bull market to end, but we're at the late stages of it. So we remain bullish from a fundamental point of view. So the next thing I look at is the commitment of traders report. The commitment of traders report, again, I cannot go into much detail, but I'll show you the charts. Basically, it's the data that the CFTC, the US regulatory authority, provides. And what it does, it shows you the open interest, which means the number of contracts that have not been carried forward, let's say, from one day to the next, for the US futures markets. And then it analyzes the data from open interest, basically showing you how much the traders are the traders, how many open contracts, open positions they have. And it does that by classifying traders into three big large categories, which is large traders, which is like basically hedge funds; commercial traders, which is traders that have an a business for participating, actually they participate in futures markets because as a way of their as a function of the everyday business operation. So for example, um, Cadbury's will be participating in cocoa market as a way to purchase um, cocoa to produce the various products that it does, like cookies and biscuits, chocolate, and so on and so forth, also in futures market. So these large traders, the smart money, who buy literally thousands of contracts, they participate either as consumers or as producers. So for example, you can go into the energy market and have BP participating as a producer. You can also have British Airways as a consumer of energy. So these players in aggregate, we get to see how much are their positions, and these are literally smart money with very, very deep pockets. It's always useful to see what they're doing. So that's the commitment of trade report in a nutshell. So this is my next step. I try to see what the smart money, the big players are buying. So the three categories, as I mentioned, is commercials, those who participate because they have into markets because of their as a function of their business. So you've got large speculators like hedge funds, CTAs, trend followers, and then you've got small specs, which is basically you and I. So this is how it looks like, a chart. This is a chart of crude oil. Commitment of traders report is reported on a weekly basis. So this is the weekly chart of crude oil. At the bottom, let's try to explain this. At the bottom, you see this red line going up and down, basically, and you see the axis. It shows you the number of the contracts that commercials have, either on a either net long or a net short basis, because there are always, some participants who will be long, some participants who will be short. So you see the net position, which is like long minus short. So the current position is short 2,000 and 12,000 contracts. So this is what the commercials are doing right now in the crude oil market. Again, we will need a whole webinar to go deeper into this, but what I'm trying to show you is basically that you can use factors that explain why price moves and goes from point A to B, rather than just looking at technical indicators. Now, I've also highlighted some vertical lines. Some of them are green and some of them are red. If you see some vertical lines that go across both commitment of traders data and also the chart. These are my alerts from a mechanical system I have that tries to identify extremes in real time on the data itself. And the way I use it is when I have a bullish extreme and the software plots a green vertical line. Sometimes I have it as an arrow, as you will see in the next few charts. Then that's a setup for me to start looking to buy. You can see that this correlates quite well, I would say, with tops and bottoms, although it doesn't catch the actual top or bottom, and it's never my intention to do so. I actually try to avoid that. And what happens here is, as soon as you've got such an alert, then you go into you've got a green light to start looking to buy, or a green light to start looking to short. I do not use it for timing purposes because, as I mentioned, first of all, this is the weekly chart, but it is an excellent setup tool. As you can see, when you've got a bullish alert, usually prices usually rise, and when you've got a bearish alert, prices usually fall. So what I do is when I look at this on the weekly chart, then I go into the daily chart. So for now, we had about 1, 2, 3, 4, 5, 6, 7, 8 weeks ago, we had the bearish alert for crude oil. So strictly speaking, we should still be, up until we get a bullish alert, we should be still looking to take short signals on crude oil, although we're probably a bit overstretched on the bear side. But strictly speaking, from a commitment trader point of view, we should be looking to short. This is the same chart for natural gas, although I've taken the liberty of putting, instead of vertical lines, I've used exactly the same thing as arrows. Sometimes I try avoiding using the arrows because people sometimes mistake it as signals, but we'll just say whenever you've got an alert, try to use it as that. As when even you see an arrow, you try to use it as an alert. It's not a signal per se. So sometimes I try to avoid using the arrows. So these work quite well, although they're not perfect. So for example, going from left to right, you can see the first um, bullish alert we had worked quite well. So did the second bearish alert. So the second alert, which was bearish, the third one wasn't that successful, I would say. And then the subsequent two bullish alerts worked very well. The third one not so and so. And the last one, we're pending to see how that will go. That's the more recent one. So we've got the alert on that last week, so we should be seeing some weakness or not going from natural gas. So once I've get an alert, then I go into the daily chart. It's not a license to sell short or to buy long. Again, as I mentioned, I'm using my macro setups for directional background. And this is how it looks like for GC, gold, basically. Again, I don't know if you prefer the vertical lines or the arrows. So going from left to right, you see you had a bullish alert as the commitment of traders, the commercials were accumulating. At that point, I had an alert. So for the next subsequent 7 weeks, the market was rising. So 7 weeks you had to apply your signal generating mechanisms, look for buy signals. Then we had a sell alert on the 22nd of April, actually, and you can see the dates on the bottom of the chart. The market actually did not fall, but it went sideways, so it's lost upside momentum. Don't forget that this signal was completely counter trend. And then on the 1st of July, we had the bullish alert, which lasted up until the 4th of November. So basically for the whole of the summer, the commitment of traders report accumulation distribution system, if you will, was bullish. Then on the 4th of November, we had another bearish alert, another distribution alert, because that's what commercials basically do, accumulate and distribute. And again, the market reacted up until the 6th of January, going sideways for a couple of months. Again, on the 6th of January, we had another bullish alert and another one on the 10th of March, which is quite recently. Last week, we had another bullish alert and accumulation. So this is something to keep in mind for gold. What I do for my own personal use, I see one market at a time. So I don't get confused. So I look at, for example, gold, I look at commitment of traders report, then I look at sentiment, then I look at and the other factors as well, but for one market. But now, because I'm trying to show you as many charts as I can to see that this works across markets, we'll be seeing various examples. So this is the second factor. I look at my macros, this commitment of traders report, which in a nutshell goes to show you what the big money, large speculators, commercials are doing with regarding their positions, either accumulating or distributing. Again, there's we can be having a 2-hour webinar just on the commitment of traders report, but I hope you understand and basically intrigue your pick your interest to go beyond price and start looking at the factors that create price trends. So first of all, as I mentioned, the market cycle. So which is the third macro factor I look at? Then I look at market sentiment. This is a very, very big factor because I consider it extremely important, because sentiment is basically inversely related to liquidity. The more people feel bullish, the more they will invest. The more they will invest, the less cash they will have on the sidelines. And market tops are not created as uh, Tom DeMark famously says, and he's quite right on that one. The tops are not created by smart sellers, but basically by buyers that cannot invest anymore. So it's an excellent contrary indicator sentiment, market sentiment for tops and bottoms. So again, this is another proprietary indicator created for market sentiment. This is again gold, and you can see when people are the indicate. This is not price based. This is uses other types of data, again macro data, and you can see when the indicator is at the bottom, it means that traders are very bearish, and when it is at the top, they're very bullish, and usually markets fall. Now again, these vertical lines do not correspond to the sentiment indicator, but the commitment of traders report, and I've left them there on purpose so you can see how everything ties together. So you go, if you notice on the left side of your chart, you've got that green vertical line, which is the commitment of traders report accumulation signal, but it also coincided with an extreme bearish sentiment. So you had two factors there telling you that gold is ripe for a rally. So both bearish sentiment, which is bullish, and also accumulation by commercials. The second vertical line, the accumulation, you can see that the commitment of trade report signaled a bearish accumulation signal, so distribution signal, but that had been already presaged by some over bullish sentiment. And you can see that this is how it works. For example, the last bearish sentiment, the last red vertical line, the had a commitment of trader report distribution signal, and also market sentiment was also very high. Again, two factors pointing at the same direction. And coming now to the March period, the indicator got very, very close to signaling. Actually, didn't, but again, we'll take some leeway and see that the market sentiment was very bearish, which is actually at an extreme, close to an extreme, which was actually bullish. Again, this is how you look at the factors and the indicators in an objective way, so you can become hopefully a rules-based trader. Again, same thing here for crude oil. Sentiment readings, with most of them go with tops, and sentiment, extreme sentiment goes with bottoms. And this is another sentiment indicator. Actually, it's a breadth, not strictly speaking is not sentiment, but I use it in that category, broad category of sentiment indicators. This is for the S&P 500. This is a breadth indicator. It's the percent of stocks of the S&P 500 that are above their 50 bar moving average, which basically show you how many stocks are in an uptrend or in a downtrend. So when more than 80% of stocks of the S&P 500 are above their 50 bar moving average, that's a sentiment extreme. And when they are below, that's another sentiment extreme. And as you can see, we actually, using this particular indicator, we haven't still got, we got very close to signaling, but not yet. So from a sentiment point of view, using just this indicator, the S&P 500 isn't as oversold as it should be. We haven't seen this washout from a breadth point of view. It's still holding very well. Again, now this is the again, sticking on sentiment. This is the McClellan oscillator. The McClellan oscillator, basically what it shows you is you've got the advanced decline line. Basically, the advanced decline line is the NICE. You've got calculates the number of stocks that are advancing, that are higher basically than the previous day. You've got the stocks that are lower than the previous day, and you see what is the net figure. And Sherman McClellan actually created an indicator. Basically, he took that series and created like a MACD indicator of that. And when that is positive, it shows you how the market advances, because you have more advanced stocks than declining. And when it is below, it's a negative number. So it's like a MACD of market breadth. And currently the indicator turned bullish. So from that point of view, although the percent of stocks above the 50-bar moving average wasn't bullish, the McClellan oscillator is. So again, we're sticking with sentiment, but we're trying to attack it from different angles. Again, there are more, of course, there are a lot more indicators than that. So I'm just showing you how I would approach seeing the markets from not purely from a technical price-based point of view. So after sentiment, then what I usually do goes the seasonal. I've got created a seasonal index, and again, seasonality is a very, very big factor. I usually leave it, of course, at the end, because I consider the other ones a bit more important. And if everything lines up, then I use seasonality as a way to basically time my entries a bit better. And this is again the chart of S&P 500 futures. The bottom panel shows the seasonality of the S&P 500. Now, there are many techniques to use with seasonality. First of all, it's the actual calculation of the indicator itself. There are many things one has to watch out for, but I won't go into that. But and also how to use it. For example, time periods. I mean, will you take the seasonality of 5 years, 10 years, 15 years, 20 years, all the data you've got? And what I do is basically from all the available choices I've got, I try to see which one has the biggest correlation with the current time period, because you've got a number of ways, of course, to calculate seasonality, but also look back periods. And this particular one I'm using, you can see that it correlates quite well. So the market is following the script. So on the 18th of February, when you had the local high for the seasonal indicator, you see that, when the that happened to be for the S&P 500 as well. Bottom for the 13th of March and 24th of March. So during this period, the seasonal indicator says that historically we should be start seeing some kind of a rally going forth. Of course, seasonality is just one of the factors, and the market is not obliged to follow its usual annual pattern. Again, now we see for crude oil, same thing, seasonality. Again, you can see that around the 18th of March, bullish sentiment and seasonality kicks in. Again, same thing for copper futures, bullish seasonality up until the beginning of May. Again, seasonals, the market seems to be responding to seasonality. Now we've got a completely different asset class, bond futures, German fixed income, showing that there is bearish seasonality up until the 20th of May. Of course, this is not to be followed blindly. We try to match it up, if you will, against what the price action actually is doing. So when I've got two of these factors going together, what the market is supposed to be doing based on seasonals and also what it's actually doing, then you've got a better probability to have a directional trade. So now that we've got the seasonal index, next thing I look at is the market map. So basically created a uh, six-stage map, if you will, to classify market trends and get literally a map where markets um, are placed based on the trend, the short, intermediate, and long-term trends. And also, so that's the market map model. Again, will take some time for me to explain. And there is a second technique I use based on 200 bar moving average. And for this particular webinar, I'll be focusing on the second one, the what I call the SMART 200 bar moving average. So what I've done is basically take a 200 bar moving average and use it in a different way, not just have it binary, bullish or bearish. You're above it, you're a bullish trend. If you're above it, it's bearish. But I try to find uh, various stages, if you will, of behavior of the market above or below it. And so these are the stages I've created. Basically, if the um, market has just crossed, if you will, the moving average, that what I call an emerging bull market, and it has basically had a bit of a run, then I call it an established bull market. And if whenever it has a counter trend move, that's why I call it a warning. It's the same thing for bearish trends. So you've got emerging bear markets, established bear markets, and also got warning. So basically counter trend moves like bear market rallies. So using these stages, I've color coded the indicator, and it is an excellent tool not to tell you just when to buy, following the trend, if it's above, buy, if it's below, short, but also help you with the timing as well. So what we see here on the S&P 500, again, going from macros to technicals, uh, a as long as the market is above the 200 bar moving average, I'm looking to buy. But also, when it is green, then I'm looking to take buy signals more aggressively. This is the more recent picture of the S&P 500. I don't know if I should have done this, but what I've done is basically took the placed vertical lines on to highlight the areas when the 200 bar moving average is bullish, and also placed some green and yellow shaded areas. So during these shaded areas represent the green part of the 200 bar moving average, and you can see the market was rising aggressively. So on a real-time basis, you can have a system that tells you whether you should be looking to buy or not, and also how to improve your timing. So for example, for the S&P 500, the market, the smart moving average turned bearish, or actually it turned to the warning side, if you will, of an uptrend on the 16th of December. So since the 16th of December, you wouldn't be buying unless, of course, you were going for a dip. Usually when I have the warning sign, I wait for aggressive dips, which I will measure through the MACD. So this is how it looks like based on the SMART 200 bar moving average. So since the 16th of December, you should be abstaining from buying. Now, if you wait for it to turn, you will miss the bottom. It's not supposed to be picking tops and bottoms. If you want to do that, you better be using the MACD. You will be late to enter, but you will be more. You'll be. That's the price to pay for a more conservative approach. Again, this is the same thing on the DAX. It turned bullish on the 2nd of December, and it hasn't turned since that. That's a brief period around beginning of March. But by and large, since the 2nd of December, you would be taking buy signals on the DAX futures without any hesitation, following a strictly systematic mechanical approach. So even if you completely dismiss, which I would advise you not to do, the fundamentals, the macros, and you said, okay, what should I do? Should I be buying or shelling? The question is, are you above or below the 200 bar moving, the SMART 200 bar moving average? And how aggressive should I be? As long as it's green, don't wait for big pullbacks. When it becomes, sorry, as it becomes yellow, as long as it's green, don't do that. When it comes yellow, then you turn to the MACD to help you basically fine tune your entries. Again, same thing here. This is on gold. Now, the vertical lines are the COT accumulation and distribution periods, something that we saw on the macro part. And I've left this on purpose to show you how you can combine technicals and fundamentals. So let's take it from the left side of the chart. Friday, 1st of March 2024. So that's when the commitment of trade report accumulation system turned bullish. Now, on the weekly chart, what we're seeing here is the daily chart. So as gold was rallying, the SMART bar moving average was green. So up until the 22nd of April, you had all this time to apply your buy signal. So on the 22nd of March, you had the commitment of trade report sell, distribution alert. So up until the so you had the alert. From mid-June, the SMART moving average became yellow, so you very conservative. On the 1st of July, you had the commitment of trader report accumulation signal. So all the way from mid-August all up until October, you had all this time to buy. You had two factors telling you to buy. The commitment of trader report, a fundamental factor, and also you had the trend. So you had two factors telling you to buy with, from two angles you are approaching the market. They will telling you the same thing. So this is how it looks like now. On the 10th of March, you had another accumulation, and of course the SMART 200-day moving average is green. So again, you've got both macros and technicals telling you the same thing. Again, same thing here for the crude oil. The obviously the market is the moving average is red, so you should look to take short signals, and you've got a potential green, which is basically on seasonality. Again, same thing here with GC. Oh, you mentioned this. All right, so this is the trend map. I try to classify the trend, the market on the trend, basically on the market map model, 8 stages. A simpler version is the SMART 200 bar moving average. So the next thing I do is I look at relative strength, the relative ranker. So these 62 markets that I'm following, I've got them on the market map classified, but even if they're classified in the same category, you don't know which is stronger or not. So the trend basically is your direction. If you look at it from a car analogy, the trend is your direction. Are you going north or south? And relative ranker is basically the odometer, because two cars may be leaving from one direction to go towards the same direction. For example, leaving from London to go north at Birmingham, but one may have traveled 10 miles and one may have traveled 50 miles. So that's both bullish, but the relative strength is your odometer. So this is what I do. I take these markets, and what you see here is the instrument name and then RR, which is relative ranker. And then using an algorithm, I measure its strength, not just direction, its strength, because all of these markets are bullish. But as you can see from the relative ranker, they have different strengths. So currently from the markets I follow, and of course this you can do for all instruments. For example, if someone does stocks, you can apply it on your universe. What I'm showing is for the futures markets that I follow. The strongest market is currently the DAX, then it's gold, then the Athens Stock Exchange, which is actually recently upgraded a couple of days ago by Moody's to investment grade, and it's one of the top performing um, equity markets for the past, I don't know, 7-8 years. Cattle, Hang Seng, Eurostox, aluminium, live cattle, natural gas. So these are the Bitcoin. So these are the strongest markets right now, asset classes. So then I obviously, as I mentioned, rank all of them from strongest to weakest. And Japanese bonds and orange juice, Mexican peso, Canadian dollar, long yields. These are the weakest markets. So to give you an understanding, better understanding of the numbers, anything above 150 are really strong. So this is the markets you should be. If I've got technicals and macro going the same way, these are the really strong ones, and the strong ones I really want to be focusing on. And I've got, as I mentioned, gold highlighted there to show you that we've picked really strong market, good technicals, good fundamentals. And then you've got the weakest market. So if you want to be looking to short, these are good candidates. Of course, given that you follow the trend and the macros as well. Again, this is the Athens Stock Exchange, as I mentioned before, since 2006. Greek economy upgraded to investment grade by Moody's. The Greek equity market bottomed February 2016, and since then it has risen 300%. And just for comparison, the S&P 500 rose about 200%. So you can see there's a huge difference. Again, plotted the 200 bar, the SMART 200 bar moving average. And with that, you can actually, again, help you both answer the question, should be buying or selling, and also should I be long or short? Sorry, better time you with the, help you with the timing. So once I've got the relative ranker and I see which markets are the really strong ones I want to be focusing on, then I look at the MACDV model. This is the indicator that I got awarded for. And of course, the bonus will include is about this indicator. Again, this is the S&P 500. What we see, the basically at its basic level, the MACDV's got 7 ranges. If someone contacts me through the webinar, I'll send them a webinar. Send me an email, I'll send them a webinar to explain a bit better the ranges and the functions of the MACDV indicator. So for the here and now, what we see again, ES futures, the MACDV is below -150, which is at the rundown range. Basically, it's like kind of like oversold for bull markets, which is a very, very good point to start looking for buy signals if you're in a bull market, because the indicator is different. I mean, it has its classic overbought and oversold levels, the risk ranges as it's called, and as I call them, but we can adapt these based on bull markets and bear markets, because in bull markets, oversold is different than it's on a bear market. So for a bull market, I think if it's going to be intact, this is probably as low as it can go. I've mentioned all of these in the paper, which I can share with you, and I've done a few studies on it as well. Again, gold futures, looking to MACDV. Again, I've got the vertical lines is the commitment of trade report accumulation signals. Now we're seeing at having the same view on the daily chart and how you can use momentum to better highlight the the speed of the market, and also help you with the entry points. As the MACDV is above its signal line, again, signals can be more aggressive, and you can see how the accumulation, we had signal on the alert on the 6th of January. The market responded to it. You had very strong momentum. When the MACD went above 50, then you knew that it was very strong. So you had to be really aggressive with your buying. Likewise now. And this is how it looks like for light crude oil. Again, after I check the trend, I check the odometer, relative strength, and also the speed of the strength, because that helped me put in context my buy and sell signals, and also pattern recognition. Momentum is very, very important. So now that I've got trend, relative strength, and momentum, the last part I look at is volatility valuation index. Well, basically these are the core 4 macro and core 4 technicals I look. So volatility is basically to tell me when the market is at an extreme. sort of like overbought and oversold, but from a different point of view, because volatility, and I learned this from John Bollinger, this quote, and he was, right to say this, that high volatility is, so low volatilities are where trends are born, and high volatility is where they go to die. And that was a very interesting quote I heard from him, and I thought it made me started thinking. So how could I quantify high and low volatility? What is it that I can measure when volatility is high and when it is low? So I created the volatility valuation index to answer this question. And when I applied to the chart, I found that he was quite correct. When volatility is high, that's when trends end. Now, the magic thing is, um, that this is when trends and trends, not, it's not an overbought and oversold indicator in the sense that when it is low, the market is as a bottom. You can see that counterintuitively, that when the indicator is high, you can have bottoms or you can have tops. It's trend agnostic. But what it tells you that the current market trend you have is about to finish. And this is a very important point. So for example, the volatility valuation indicator I've got here for crude oil, when it reached 3 times an extreme, the first 3 times that is, you can see it ended the current trend. But the first time it was a downtrend, second time it was a downtrend, the third time it was an uptrend. So this is what very, very interesting, that the volatility valuation indicator, a high reading, you go with both tops and bottoms. So it's always very important to look for extremes. Now, if you're at the bottom end, so you've got extremely low volatility, then you should be looking for a trending market. This is the example we have with highlighted between December and January. Again, this is for gold futures. The first volatility extreme went with the top. The second volatility extreme went with the bottom. The third volatility extreme went with the bottom, and the third one with the top. Again, this is very fascinating. It's not an overbought and oversold indicator where you get overbought and obviously the market looking to go down or at the very least sideways. This is trend agnostic, but it just tells you the current trend up or down is getting exhausted. So as we look at the gold futures, there is no sign of volatility extreme. So we've got a green light from that. Again, same thing for the S&P 500, volatility extremes. And these four particular extremes all went with bottoms. This is what usually happens with the S&P 500, with equities. But for commodities, extremes are more occurring at tops. So what we have here is a very interesting piece of information. So I've left the MACD from, although we're not examining momentum right now, but we're examining volatility. I've left it on your chart just to highlight that both momentum and volatility are at extremes, and they set up a high probability setup for the market to start rallying. So both from a volatility and momentum point of view. So now that we've finished checking the markets from a macro and a technical point of view, and believe me, once you've got this systematic approach, repeated a few times, believe me, it won't take you more than a few minutes to analyze any market on a rules-based, systematic, step-by-step approach. So once I've done the macros and the technicals, then what I do is, try to put this together into, combine this into a strategy. So the strategies, I think, have four components. So the first part is the setup, and which basically tells you should I be looking to buy or should I be looking to short, and how aggressively. So this is what I call the setup score. This is how it looks like. So each week I segregate markets into long and short. Well, strictly speaking, I've got strong, long, short, and neutral, because some markets I just don't know. I don't have a strong enough conviction. But because it's not strong enough, I just won't examine it any further. So strictly speaking, literally speaking, it's long, short, and neutral. But because the neutral will not be part of any further investigation, just focus on long and short. Again, these are the markets I'm looking at right now. I haven't included the other ones not to confuse you, because I just showed the examples for the ES, gold, and crude oil. So this is how it looks like. So 8 trades are my best trades, the best setups on various, again, on a rules-based way of combining the technicals and the fundamentals. B trades are also okay. C trades and D trades are less quality, less, not as good quality as A trades. So not just being long or short, but also what type of conviction. And this is very, very important. A, to say, okay, I want to be taking A and B trades. Obviously, A trades and B trades are not that often, but also it's very important because given your conviction, you will be having different position sizing. For A trades, you can be a bit more aggressive. For D trades, you can be very, very conservative. So from the examples I've shown you, the A trades classification is the ES and gold. And for crude oil is the, it's a B short trade. Again, you can make notes on, why you think so and so on and so forth. Again, very, very systematic, rules based. Each week you do that. So Monday morning, your focus list, your watch list, your setup score is there, and you can focus on markets rather than going randomly from one to the next, from chart to chart. Looking at Twitter or looking at the news on what Trump did or some analyst said. You're very, rules based. So you've got the setup score, which tells you these are the markets I want to be focusing on the long and the short side. So what's the next step? So first is the setup, second is the signal. When you actually physically get in, so what is the step you're following to take it from a setup to a signal? So setup is rules based, but there is also an element of discretion, in the sense of I want to be taking only A trades or B trades, or some markets are bullish, but I'm not feeling very confident about it. So there is an element of discretion there. So the system is semi-systematic, as I say. So two parts of it are systematic, two parts of it are fully mechanical. The signals are fully mechanical, which means once your setup score, your watch list is there, and you say these markets I want to be long, this much I want to be short, and you want to actually enter, then what I do is take the S.M.A.R.T signals indicator, which can be either indicators or patterns. For example, the MACD, or patterns, double inside days, fake breaks, and so on and so forth, various indicators and patterns. And what I do, I use this to create buy and sell signals. Now, a big warning. On this chart, I've got short and buy signals. I do not repeat, I'll say it once more, do not take all these signals. I've placed them just to highlight that you have both long and short signals, but you pick and choose depending on your watch list bias. So when you have when the market is on the long watch list, A, B, or C, D trade, then obviously you're going to be taking just the buy signals. So in this particular example, the S&P 500, I've left the MACD and also the volatility valuation index, which both started saying we might be approach a bottom. So we had the buy signal yesterday. So this is how it would look like if during all this period you were looking to to follow the trend. You would be just taking the buy signals. You would not be even considering the short signals. Now you can see some buy signals are within the green part, if you will, of the moving average, and some are in the yellow. Again, these are there are techniques to further filter these based on the MACD, but the more aggressive ones, which are during the green part when you're basically the bullish part of the 200 bar moving average. So the first one, again, you'll be looking at the MACD, making a higher bottom. These are patterns of the MACD. Again, this is another signal that would work. This is another signal that would work. This wouldn't, this wouldn't, this would, this wouldn't, and now you've got a new one. So even if you just focused on buy signals, by following the trend without filtering any further, you would still do probably relatively well. Again, very, very, very important. This signal generation mechanism, you can filter it now. For example, just what I did is I filtered it and said, just show me the buy signals, because we're in an uptrend. You will be called to choose which signals you want to be following. So for my the short candidates, I will not be looking at buy signals, just shorts. I will not be taking every signal. Again, same thing with crude oil. I've left both long and short signals. The vertical lines, as we mentioned before, is the COT report accumulation signals and distribution. So when the line is green, you look for buy signals. When it's red, you look for short signals. So this would be, you would be taking the signal, you would be taking the signal, not taking the short signal, because you are during the period of commercial accumulation. Plus, if you look at the second panel, the MACD is above its signal line, so you've got good momentum. Then you had the COT system telling you look to short. Momentum is also bearish, so you will be taking that short signal and ignore the buy signals. But I'm just showing you because obviously in the first period you will be looking to buy, and the second period you're looking to short. But when you're doing it real time, you just pick one side, just buy, just short. You don't do both. Again, this is the mechanical entries for the DAX. So let's just sit for a little while. Right. So what is the four parts of the strategy? So first is the setup, then is the signal. This is the 4S framework. The third one is stops. So how do we ask what get in? How do we get out? Well, they're basically four types of stops. You've got stop loss, take profit, which can or a trailing stop. Take profit can be a hybrid techniques, or a profit which is for like average through range, and a trailing stop. Again, this is the trailing stop technique I've got. When you've got the buy signals, it shows you start trailing it up until it's completely mechanical. Another example could be here. Again, this is from the DAX, a very recent one from the signal we saw before. And then the recent signal we had for gold futures, it's very mechanical. It just starts trailing it. There are various ways to trail your trades. I'm just showing you the most basic one. So the forest framework, and somewhere around here, so we've got the setup, why you want to be long or short, the signal, when you get in, the stop, and obviously the size. Again, the size is a function of how aggressive one feels, and that comes back to the setup. That's why the trade grade, the setup is very, very important, because it will also relate to size. And these are the two discretionary parts. So if you've got the setup, if it's very aggressive, you risk 2% of your portfolio. Again, I'm talking about for futures trading. Or it's very conservative, 0.5%. Usually you should be around 1%. Again, these are the attendance bonuses for those that manage to stay with us. And if you've got any questions, feel free to send them. Contact me by email. And with that, I would like to thank you very much for your attendance. Hope I'll be seeing you again in 2 weeks. We'll be doing another webinar, an update for the trades we showed here, and probably new ones as well. And I would like to thank you and wish you all a good evening. Thank you very much.